So where are we going? We're seeing a lot of humor in advertising campaigns. Inc. magazine says that. So we're going to, we have this sense of humor because just like we did in January, we're going to look at some quotes and some people are saying some things that are just diametrically opposed to each other. So if you spend enough time with media, and I spend an insane amount of time reading people's thoughts about the economy and markets. And it's just, for me, it's just fun. I just think it's hilarious. So this guy says, I don't even know how to, there's got to be a way to read this where it makes sense. It says, beware the Ides mid-month to the calends, first of the next month of August, as well as some dates in September and October. So he's saying August 26th, August 30th, September 26th, and October 20th. Date specific. Like, this is when the world's going to fall apart. We're currently in a very dangerous time zone between 2011 there's an 84-year cycle. You better be careful. And then this, he just looks happy. So the other guy, it's all bad. This guy, life's full of risk, but being in stocks is, when everyone is bearish, isn't one of them. So one of the things they talk about the wall of worry, like if the wall of worry exists, you're not at a top. You're at a top when everyone is saying buy, 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 buy. That's the top because everyone's already in. And no one else is left to buy, and that's the top. We're nowhere near that. But look more. This is where that quote came from. It's really the growth in social spending transfer payments, Social Security. They'll continue to support incomes and push the market up for years to come. Social Security, Medicare, Medicaid. These non-discretionary payments will continue to grow for the next 15 or 20 years as baby boomers reach retirement age. That's a massive, untalked about fiscal stimulus, right? Massive. 10,000 people a day are retiring and taking Social Security. That's a lot of money. It's coming out. That should boost economic spending, one would think. So this is Schwab Market Perspectives. This guy is Jeffrey Kleintop. Jeffrey Kleintop is now at Schwab. He was LPL Financial's chief economist up until like a year ago, and Schwab snagged him. He's great. But so, a lot of opinions. This isn't a comfortable time for investors, which isn't a bad thing from a contrarian sentiment perspective. So contrarians, there's momentum people that say, hey, whatever's going on, that's got to be the right thing, do more of that. And there's contrarians that say, whatever's going on, probably should ignore that, that's bad, let's do something different, right? And when you think about, in the beginning, we talked about sentiment, and sentiment was really, really bad in February, and we bought, and we're hoping for sentiment to get bad again, and we're going to buy more. See, my perfect world is I'm all in on equities. I love equities. I think equities are fantastic, but not at expensive prices. Like I want to pay for them at the right price. And so we'll get them. It'll come over time. Here's another one. Stanley Druckenmiller has been basically saying this. He, Grantham, John, what's his name? There's just 3 or 4 of these.
The guy from PIMCO.
Not PIMCO. Hussman, John Hussman. Just always negative. He gave a massive presentation, and this is interesting. The Fed's objective seems to be getting by another 6 months without a 20% decline. Like everything that they do, and I'm not as a pessimist in this fashion, but they really are paying attention to what the markets are doing. They really are not allowing the market to value securities in the way they should be valued. And this is global. We don't know what's going to happen. We still don't know what's going to happen if we just would let interest rates be where interest rates would go. We're stimulating so much, and it's not, in the US at least, there's no reason to panic here. I mean, unemployment is under 5. We're adding 200,000 jobs a month. Our economy is bigger than it's ever been. Our individual, composite net worth is higher than it's ever been. Our gas prices are cheap. Our debt service is lower than it's ever been. So there's all kinds of reasons to be positive. And yet we have a 0.4% Fed rate. It's not an emergency scenario. It's a little weird. And we don't know what's going to happen when that goes away. But I want to see it. I want it to go away so I know it's real. All right. So this is what we talked about before. UK 2.2, 1.9. This is before the July update that came in after Brexit. It's now 1.8 and 2.1. Euro region, the Euro region's total decline was to 1.4 in 2017. The United States got 0.1 knocked off. It's not a big deal. And as it happens, what does it mean to have 2.3 instead of 2.4 growth on a 18 trillion dollar economy? It's really not a big deal. So if we lose 0.1 in GDP and if gas prices go up $1, we lose 0.1 in GDP. Or probably more like 0.3 in GDP. That's a bigger deal than Brexit, economically speaking. Okay. This guy says U.S. economy is at risk. He talks about the Fed. He's in BNP. We're not paying attention. We're paying attention to a couple of things. We're not paying attention to these other things. And he's right. There's mixed data. There's absolutely mixed data. She's saying U.S. is in great shape except for these four things. Labor participation is declining. Productivity growth has declined, which we talked about. Why is that? We're not investing in plant equipment. Distribution of income, that's a big deal. Share of the population living in poverty is at high levels. Relative to history in the U.S., I don't think that's true. It depends on what you call your poverty level. Global recession is possible. This is basically China. This is Mr. Soros talking about China. So there's people saying, hey, it's all good, it's good, and there's other people, it's real. And that's a really good sign. That's a conversation going on in the economy. What's happening? Well, we don't know. There's this data, there's this data, there's this data, there's this data. Okay, so this is the FOMC. Notice how every single time we take this vote, they're saying there is less of an expectation that rates are going to go up. Okay, U.S. bonds are risky. U.S. bonds are dear. Like some people say, we love U.S. bonds. Some people say U.S. bonds are a bad idea. So Mark Mobius says emerging markets may do well over the longer term. Okay, I agree. They'd be very volatile, but they're going to do well over the longer term, and that's what I want to get to. I'm going to pop through this. So emerging markets may do well. They haven't for 5 years. But why is it that financial markets are the only markets where things go on sale and everyone leaves? That's what emerging markets is. The capital flow out of EM is insane. And again, what did I say? I said August of last year and February of this year, that's one of the things we invested in. We added capital to those places.